So for property market, there are a lot of local governments actually loosen up the restrictions and rules and regulations on new home buyers. As for the financial risk, the officials has actually just passed new law amendments that allow local government to issue municipal bonds. So this would subsequently replace shadow banking system, as well as slowly phase out the local government debt. So with this, we also see that the inflation remains benign, moderate, well below government's target of 3.5% here. And for the PPI, the Producers Purchase Index, it continues to fall at the 30th consecutive month in July. So we see more scope for targeted easing. Sorry. Okay, so this is just a brief overview on China's stock market. And these are the short to medium term catalysts, the encouraging reforms and our hopes on more fine-tuning measures. So for Shanghai Hong Kong Stock Connect, despite that there are some problems faced, it is still being expected to go online as scheduled on October, tentatively on October 13. And there are still opportunities on the A-shares Chinese stocks. So moving on to Indonesia, Jokowi, the new elected president, will be installed as the president in October 20th. And for the economy to grow at, economy has to grow at 7% to create jobs and to reach sustainable growth, as well as to reduce poverty. We see that the trade balance returned to a small surplus in July. And on the upside, Indonesia actually made its first exports of mineral concentrates in July after 5 months of soft demand due to a dispute between mining companies as well as the government. Okay, these are the few the risks that remains with Indonesia. The twin deficits, which is the fiscal as well as the current account deficits. They have really improved, but yet to be resolved. So to reach their goals, they have to unwind the fuel subsidy, which we expect it might have a second round of fuel price hike in November. And government also have to open up FDI to boost economic activity. And the ban on mineral oil exports may cause some short-term volatility in their trades, but this will be good to their economy in long term. So a snapshot on Indonesia's stock market. And the development in moving on to Thailand, the development in their politics. So the latest development will be last week. Thailand's military-dominated legislature, meaning their parliament, has actually given themselves the power to impeach political office holders, a step to uproot the influence of controversial former Prime Minister Thaksin. And we see also stubborn challenges to revive the economy, with economy expanded at 0.4%, avoiding technical recession. And we see that from here the Thai business as well as the consumer sentiment improved as political tension eased. And current account actually, from here, current account actually swung to a deficit in July. Trade account also not looking good. However, the soft inflation will provide some room for the MPC to maneuver the monetary policy. Okay, just a snapshot of the Thailand's stock market. Okay, for Malaysia, GDP actually accelerated to 6.4% last quarter. So if Malaysia continue with this momentum, it would exceed the official forecast of 4.5 to 5.5%. So this will add scope for the central bank to raise rates for the second time next year. Second time in this year. So if the central bank is going to raise interest rate for the second time by end of November, this will this will worsen the situation when the Malaysians are actually already struggling with mounting cost of living. So we expect that consumer spending is likely to dampen somewhat. But this will actually help to improve on the government debt, which are actually touching the line of the debt sitting at 55% of GDP. So a snapshot on the Malaysia stocks market. As for Singapore, the Singapore economy remained resilient, with GDP rising at a marginal 0.1% last quarter. This is due to the structuring plan which government pursues on to slow down inflow of foreign workers as well to boost productivity and attract new industries. So we see that there's a pronounced retraction in manufacturing sectors. On the good side, we also see that industrial production accelerated. NORDEX recovering. And we expect that the economy will grow at a moderate pace, benefiting from a recovery in global growth. And externally oriented sectors are expected to support the economy, while domestically oriented sectors such as services are expected to remain resilient. So this is just a snapshot on Singapore's stock market. Okay. With that, we will move to the US macro, which I'll pass the presentation to Sam.
Morning, everyone. This is Sam, and I'll be covering G3 economies: US, Eurozone, and Japan. So, starting with US. The U.S. economy continues to expand steadily with expectations of 2.4% of real growth. The thing with U.S. is like data coming out, including non-farm, private, and manufacturing payrolls, plus the ISM manufacturing and non-manufacturing data. They are coming out like better than expected, confirming a steady domestic growth. Labor market continues to show steady improvement, and has been below 7 for a few months now. You can see on the chart on the right hand side the PMI, the manufacturing services both pointing upwards. U.S. employment, you can also see it picking up on an uptrend. Retail sales is also improving after the slump in the first quarter due to the inclement weather. Confidence metrics remains mostly solid. Whether it's business confidence, consumer confidence is really positive and solid. The inflation remains at around 1.7%, which is still below the target of 2%, but is trending upwards, which is actually a good sign that shows that the economy is picking up. Fed keeps up with their tapering program, but determined to continue their loose monetary policy overall. Condition in the U.S. credit market remains solid despite all these tapering program and the talks going on about the rate increase. QS remains the housing market, but to tell you that this market, the sales and the constructive activity has actually rebounded in the last few months, suggesting that it's not as weak as the economists were thinking it might be. We got few proxy US unit trust and ETFs here as well to take a look. Okay, then here we got few charts: US industrial production chart, business sales chart, new orders chart. You can see all the data chart picking up, like trending upwards. We got some more nominal US nominal personal income, disposable income. You can see there's a rebound, which is a healthy sign for an economy. So right now, for US, we are neutral weight. We're actually long-term overweight and short-term neutral. And a lot of people keep asking, like, if the economy is doing so well, why neutral weight? So the reason is, economy-wise, is an overweight. Equity market-wise, is a neutral weight. Now, this equity market-wise, the technical part will be covered later by my colleague. in a technical analysis, but technically the neutral weight is on the equity market itself. Because as I mentioned, the fundamentals are strong and you can expect buoyant conditions to prevail for years to come. Moving on to Eurozone. Eurozone, we have downgraded Eurozone from overweight to neutral weight now. The reasons Eurozone's feeble recovery came to a halt in the second quarter. GDP result in Eurozone for the second quarter was disappointing. And the biggest disappointment came from Germany, where it posted negative 0.2% quarter-on-quarter growth. Plus, I think the August results were also negative 2.2%. Meanwhile, early estimates for Italy revealed that it had already slipped back into recession with negative 0.2% growth. So another concern. On the other hand, those peripheral economies, including Spain, Netherlands, and Portugal, did partially try to offset the deficit. Okay. Talking some more economic data. For Eurozone, the Purchasing Manager Index, the PMI, has fallen in 4 out of the last 6 months, including this month. And you can see that Germany's industrial output is down like negative 1.5% in the first 2 months of the second quarter. So Germany's industrial output, its economy growth is quite affected, mostly by these sanctions they're putting on Russia, which I'll be talking in a short while. Eurozone unemployment rate fell to 11.5%, but here's the catch: 11.5% is still a very huge number. And this 11.5, a huge chunk of it comes from those peripheral economies like Italy, Spain, Portugal, and we don't expect it to fell all the way to hit historical average levels anywhere soon. Inflation remains well below the ECB medium-term target and fell to 0.3% in August. Inflation for now for Eurozone is the biggest concern, and level of credit growth for Eurozone is woeful, but ECB has implemented a very loose monetary policy. What they have done by now, okay, number one, they reduced the deposit rates for the bank reserves further to negative 0.2%. They implemented the LTRO last week. Number three, they implemented the private QE also, which was announced a few weeks earlier. So they have already done all that they could, but the result of these things will take some time to be seen. In our view, ECB will wait until next year to gauge the impact of negative deposit rates in the recently implemented LTRO and private QE, and will only then ponder over to implement the full QE, which might, if condition remains like this, probably will take place early next year. You can see on the right hand side the CPI taking a crash. That's the second chart. Okay, geopolitical crisis. Germany has been most affected by this because it had a close trading ties with Russia, and these sanctions, which Eurozone as a whole has been putting, these sanctions they've been putting on Russia, is actually affecting Germany and its economy. Although the recent trade embargoes with Russia will not impact Eurozone exports completely yet, okay, but they may have already hit confidence and prompted corporates to hold back or delay capital investment. And this you can see with the industrial production coming off, with the growth going negative levels. So, but one point to make here is that excluding Latvia, Estonia, and Finland economies, generally speaking, the core economies export more to Russia than the peripheral economies, and that is the reason you are seeing that Germany and France are being affected more than maybe Spain or Italy. But even these core economies, Germany and France, exports are modest, implying that it would take large falls in Russian imports to have a material impact on GDP growth there. So what you're seeing right now is mostly because of the fall in confidence level, both on the business side and on the consumer side. On our report, we have put few scenarios what can happen. We still believe that this thing will last, the geopolitical crisis will last for some time, but we don't see any war actually taking place. Again, we got few unit trusts and ETFs as a proxy for Eurozone. Then I will move on to Japan. Japan, we are maintaining overweight. We have been maintaining overweight for some time now. The economic activity rose at the end of Q2, well supported by the loose monetary policy and fiscal policy as well. Business confidence has slightly recovered and shows signs of further improvement. Machine orders, which are supposed to be the leading indicators, has remained better than expected and are poised to perform better once the global economy picks up. Exports remain sluggish in past few months, but what we believe is when the global economy picks up and the foreign demand increases, plus the depreciated yen will actually help it improve it in the future. You can see on the right hand side that machine orders picking up, trending upwards. Gross exports also year on year change trending upwards as well. And current account deficit has been shrinking over the last few months, and the latest data shows surpluses in their current account actually. Inflation remains low to around 1 to 1.5%, adjusted by 2% due to the tax hike effect, but it's still below 2% the target level. But the good thing is you can see on the right hand side that it's picking up, it's trending upwards. So technically after a few months you might see it close to 2% as well. Japanese yen is expected to depreciate further. It's already depreciated a lot so far. We still believe it might go even further to 115 levels, and that will help boost the corporate earnings definitely. The market valuation wise remains attractive, trading at PE ratio of 14.59 as for the MSCI Japan Index. Key risk, like we have already been mentioning for some time now, that the key risk remains to be the structural reforms that we have been talking about, the third Abenomics era. So if the inability to implement these reforms plans adequately might unravel some huge risks, but at this point in time, we see those structural reforms like employment reforms, immigration reforms, going on the right track. We got few unit trust and ETF proxy Japan as well mentioned here in the slide. So overall conclusion will be that the global economy recovery remains intact. A premature tightening of U.S. interest rate would send a jolt to the market, but on the flip side, tighter monetary policy would signal a U.S. recovery. That the U.S. economy is doing well is the only reason that the monetary policy becomes tighter. So to cut short everything, we still maintain our stance overweight on Singapore due to strong balance sheet and resilient economy. We are technically overweight on China and Indonesia as well due to optimistic reforms leveled up by new administration. We are neutral weight on Thailand due to geopolitical crisis, and neutral weight on Malaysia as well due to Fed tapering might daunt this highly indebted country. We are neutral weight on Eurozone as well due to fading inflation and geopolitical crisis. Overweight on Japan and due to improving economic and leading indicators as well. And we are neutral weight on US, and like I said, we are neutral weight on US on the equity side as only for short term, and the technical reasons for that will be covered next by my colleague Kenneth.
Hi, mic check. Okay, hi. Kenneth here, and now I'll talk about the market analysis for this week. Okay, so here you go. So, okay, now that you've gone through the macro updates, we'll continue on to take a look at the technical outlook for it, because the importance of looking at the technical outlook is to make sure that whatever we see in the technical analysis, right, is it coherent with what we see in economic data? If it's not coherent, then we've got to question either one, whether the technical outlook has a problem or the econ data is not reflective of what's going on. So let's take a look. So to recap, right, let me just remind everyone about our stance last month. Last month, basically, we summarized the US market, which is leading all the markets basically, and we said our guidance is to have a tight stop on long positions, please. So this is what we had last week. And then we cited a couple of reasons why, but the key thing is that based on all the indicators that we use, that although the uptrend is up, but is looking weaker, and there is underlying weakness, right, for an STC, which I just call this a short-term correction. Okay, so that's what we had last month. So as of now, well, we see that the short-term correction may be in effect. We had a 2% sell down in S&P last week. So what's our stance now? Let me just summarize it before we go into the data. Okay, so the conclusion is that yes, we are still in the bull market. We've guided this for some time now, but the rest of the indicators are looking weak. Okay, the indicators that I'm using is essentially everything that is not momentum indicators. Okay, so this STC sell-off is likely not over. So today, what we do notice is that global stocks are selling off in rising volumes. Okay, and it seems that a rising dollar is hurting emerging market currencies and stocks. Now, for the S&P itself, the downside risks are increasing. Okay, a few of the reasons I just want to highlight is that a lot of individual stock moving averages have been broken. Now, take note that the end of the QE tapering is scheduled to be end of the year, and there is a preempting of a December effect, and these two are basically convenient reasons, I would say, for some people to take profits. Okay, so the key thing is that by timing what we see, by looking at the underlying strength of the market, we can tell whether the market is ripe for a correction or not. And once it's ripe for a correction, we have to look out for potential reasons why a correction might occur. So these two particular things, right, have to be taken note of. And also, we notice there's a new divergence in junk bonds. We'll get into that in the future, later on. So these three, just take note of these. Okay, so outlook for the US market. It's simple. Probability is that the US bull market has not ended yet. Okay, and we have these reasons why. Okay, 4 reasons. If you want to see the explanation of all 4 reasons, right, please go to our webinar on the 10th of February. Okay, because you don't really have a lot of time in a single webinar to go through this again. Okay, but bull market doesn't mean no corrections, and there is weakness building up in the US market. Note, we haven't seen a 10% correction since late 2012. That's almost 2 years. Sensitivity, breadth, VIX, sentiment are ripe for short-term correction. That's a lot of indicators. End of QE tapering and preempting of December effect call for caution. Okay, December effect is basically the phenomenon for a tendency of investors in the US selling off their stocks in December and then buying it back in January, usually for tax reasons. And of course, every year this December effect changes in period because market participants preempt or post-empt December effect. So the action is to have a cautious trading mentality. Tight stops should be used if long positions are initiated. The next major correction should also not be the end of the bull market, but rather wave forward the cycle. This is based on what we see in the economic data and what technical signals we see onwards. Okay, so on the 7th of July, we basically we guided that the STI has a chance to cycle up till the meaningful correction in the S&P 500 starts. Okay, so the S&P did not have a significant correction since then, and so we see that the STI has indeed cycled up. Okay, so this is where we are today. The US had continued to drift up, and now we cycle up. Okay, market updates. Now, before we go on to that, I mentioned this last month, but I'm going to talk to you about this quickly again. I just did a Elliott wave pattern on the S&P 500. Note that Elliott wave patterns are extremely subjective, and it's just a rule of thumb that we use. And I just want to say that the pattern that I've drawn is subjective, is controversial, and it disagrees with some people. But at the same time, right, I would just like to say that it fits the rules of the Elliott wave. So the Elliott wave I have is here. Okay, so basing 2009 as the start of a major wave up, right? Now, a lot of people think that this extended wave that we had since 2012 is wave 5, aka the last wave. I mean, it looks very convenient. After all, you see like a one move here, a second move here, and this looks like a third big wave. I know a lot of pundits have said that, but actually, if you want to use pure Elliott wave rules, right, that actually cannot be true. Because if this cannot be wave 3, because wave 3 cannot be the shortest wave. So if you call this wave 3, then this is the shortest wave. So instead, the only way to make it work is this. So from here to 2009 to mid 2010, that's 1. This is 2. And what we see up here is actually 3. We are actually in 3. And in the middle, we have basically a wave within a wave. In this 3, we call this an extended 3. So in this thing, you have 1, 2, and another 3 here. And within this thing is 1, 2, and another 3 here. So we're basically at the second half, basically, of a major 3. Okay, now if that's true, right, how does that corroborate with the rest of the information? And we argue that at this point in time, this actually corroborates with the information that we have, and I'll talk about my thesis soon. Okay, but what does it mean if this is extended 3? It means that the next major correction, if there is one, when there is one, it's a 4. That means major correction is a 4, and that sets up the 5th move up. That means the next correction should not be the end of the bull market, but a setup for the move 5. However, move 5, okay, please note that for Elliott wave, the move 5, probability is that move 5 will not be of the same duration as 3 if 3 is extended. In fact, the probability is high that if there's a move 5, if 3 is extended, 5 should be around the same length as 1 in terms of time. Okay? So that's what it actually means. So you find that 1, 2, and this is 3 corroborates well with the data. And this is a legitimate Elliott wave pattern, in the sense that it follows the rules, doesn't break the rules. Now, is this how true this one is? You know, depends on time. We'll see. We'll find out soon enough. Okay, but this is the thesis for now. So why do we say if this is really 3 and we're coming to the end of 3, then we're saying basically there's a 4 and 5, which means we are basically about maybe 70% to 80% done of the bull cycle in terms of time. Right? Why do we say that? A few reasons. We got intermarket analysis. We got the yield curve, which is far from inversion, and we also notice that there is a TA price objective from the breakout 2007. What does that mean? It means this. If I take this, okay, let me go back and I'll show you. Sorry, I'm looking for a big chart. Okay, never mind. Basically, draw a line across here. Okay, we notice that the S&P has been consolidating in this range for the last decade. Draw a line across basically the 10-year high here. Okay, now that we've broken out from here, we draw an objective between here and project it upwards, right? And that's also roughly a bit more to go as well. 20 to 30% more to go as well in terms of time. Okay, let me just continue first. Okay, so based on our intermarket sector analysis, right? Now this is way back from our 11 January market outlook, so I urge you to go back there and to just listen to the thesis again. But essentially, we believe for the last couple of months that we were in stage 4 of the business cycle, which basically it's at the point where stocks will show its early weakness, okay? And you should have long stocks, especially for this, and this, industrials, materials, energy. And for commodities, we said wait for breakout. In other words, we are halfway done for commodities. So since then, right, we know this is what the intermarket picture looks as of now. Top here is US Treasuries, followed by Dow Jones World Index, followed by GSCI, the Industrial Commodities Index. So the point I want to show is that from middle of 2013, right, we've seen finally this weakness here, and the way that this is treading on this trend line here, it kind of makes me feel as though this is just waiting to collapse down here. It's just consolidating along this line and waiting for the move down, the drop in bond prices. And we know this is bound to happen, just a matter of time. Okay, so basically here, this is the starting of a bear market for bonds. Okay, the Dow Jones World Index exceeds a long uptrend. Whoops. Okay, long uptrend here, and this is the industrial commodities, and you can see that it's still consolidating. Okay, that means it hasn't really done its move up here to highs. This is a downtrend, but I think this is just a long consolidation before a final breakout. When the economy recovers, this should actually break out this way. So based on these, so bonds down, stocks up, and commodities halfway there. Based on that, that's how we get this picture over here. Bonds down, commodities halfway up, and they're almost at the end of stocks. Okay, so if you are phase 4, that also implies that, yeah, we got a bit more to go before we hit the top of the stock market. Top of the stock market, basically. Okay, this is just for your reference. I'm just showing you that these are the different sectors that we look at, and the top chart is actually the price of the sectors itself, but what's more important to me is actually the bottom chart here. The bottom chart is actually the price relative of the sector and the S&P itself. So by looking at the price relative, you can see how this sector compares to the whole to the market as a whole, and we can see who the real leaders are. Because when you look at the price chart, all of them are uptrending, right? So you can't tell who really is leading what. But by looking at the relative price relative, you can tell who's actually leading. Okay, but this is for your reference, and it's a hint for the medium short term, right? Sometimes there is, if you're lucky, there usually is a sequence of which sectors move first. You can tell that, for example, cyclicals tend to move first before industrials and materials. And if you look at the price relative, you see that happening. You can see from here, 2010 is when the cyclicals lost leadership. Later on, industrials lost leadership a few months later here. And here's materials, and we haven't lost leadership yet. Can you see that? Yeah. So this is just for your reference, something interesting to look at. So based on sector rotation, right, we also feel that we are around here, okay, which is based on phase 4 strategy. So this is another way of knowing when the bull market has ended. One way is, or one signal that can help you, is when basic materials and energy start taking the relative market lead, is outperforming the rest. And the reason why is because usually basic materials and energy will lead the market when inflation becomes rampant. So this model over here, and including the intermarket model, is also based on the idealized concept that when inflation becomes rampant, central banks will tighten up, and eventually this tightening will basically drop the bond market, and that will also cause the economy to slowly turn and cause stocks to turn before that. Okay. For more details, please go back to the February 11th webinar. Okay, the yield curve also supports a bull. So very quickly, this is the yield curve as of today. So here's the SPX, the S&P 500 chart here. So this red line simply means what the yield curve is at this point in time, and that's over here. So short-term treasury bonds, 3 months, see, it's almost at 0 interest rate. 30 years, much higher, roughly just a tad off 3% here. But you can, basically the point is this: when this is what's considered normal and healthy, when the short-term interest rates are much lower than the long-term interest rates. Okay, if you look at the two bear markets you've had in the last decade, so this is done over here. This is what the yield curve was year 2000, just before the bear market itself. This is what the yield curve looks like when 1.5 years before the Great Financial Collapse occurred, and for both of them, they were characterized with an inverted/flat yield curve. Okay, and so that's what we do look at. This is one signal that we look at. Not just let me say that for technical analysis, or for market analysis to be more precise, well, just because you see one signal occurring doesn't mean that the bear market is going to start. But we look at a multitude of signals, and when we find that the more signals there are, kind of just increases the probability of a bear market starting, but doesn't mean that it will. But so in this case, this particular signal is still signaling not a bear market yet. Okay, and corroboration with the US data, which is improving but not spectacular yet, that also reinforces that we think we're still in phase 4 of the business cycle. Okay, so okay, that's the yield curve. Now, just want to look at now. So we know that. Okay, I'm going to skip this tapering right now, and we're going to talk about the S&P itself. Okay, so original slide on the 7th of July, basically we said that based on the reasons we have over here, that just a little more, we think that the price could drift higher. This was in 7th of July. So since then, it did drift higher to 3rd of September. And here's when we actually guided, looks like a short-term correction. And so since then, we have this. We've had weakness. It did not go past 1997 basically. I mean, it got up a bit then, and it basically sold off a bit, right? So what I want to show you is that even though the price, you can tell that the price has actually been going up, right? So most technical analysts will tell you, hey, it's an uptrend, right? So that's great. Yeah, that is great. But for us, we try to value add. So we try to let you know underneath this engine, right, is there weakness underneath. So how do we know that? Well, we just have to we try to scour the market, and we try to look at things that will suggest otherwise. Okay, so here are some. Now, the good thing about this uptrend is, well, the trend is still up. That's always good. Now, second, we could actually hit the top channel before sell down. The top channel is somewhere up here, 2050, maybe around there. That's actually the top channel if you draw a line across up here, right? And the US dollar is getting stronger. It's helping a bit, okay? However, there's a lot of questionable things. In the questionable way, it outweighs the good. And the questionable is this. So we have the VIX is actually still low, but increasing. Okay, that's questionable. Breadth and sensitive indicators are discouraging. Okay, it's diverging. More stocks breaking below 50-day average. As you can see, this particular indicator tells you the percentage of stocks in the S&P that is above the 50-day average, its own 50-day average, that is, the own individual stock 50-day average. And you can see that even though price is hitting new highs, but this has been decreasing. So this and this and this tells you there's actually some weakness in this uptrend that is not as strong as we think it is. Okay, so we incorporate another divergence that occurred recently, and that's this one here. This is actually the price of the iShares High Yield Corporate Bond ETF. High Yield Corporate Bond, aka junk bonds. Okay, that means high yield bonds but of a lesser credit quality. So it's always interesting to see when the stock market is going up, but finally we have the junk bonds going down. So is this signaling risk starting to increase within market participants? Yes, it could be. So in combination of the three, right, this tells me that underlying this we have to be cautious. So because it's an uptrend, right, I can't say it's a downtrend, it's an uptrend. So you can still go long, but if you do go long, you should put protective stops in place. Okay, because any down move could be quite sharp. Okay, it could be. Now, so the markets are overstretched and waiting for an excuse to correct. That's the reason why I went through this slide. It's waiting for a reason to correct. But the news, econ news that is, continues to be fairly reasonably okay for now. So what potential reasons are there? I mean, there are a couple, right? One, the Fed tapering schedule is one. December effect is two. And I think mentioned earlier, right? Next year, there's a rate cut that's being expected, okay? And it is a view of some of the analysts here that a sell-down could occur in anticipation of early rate cut as well. So these are just reasons that people can take profit, okay? So my suggestion is that bias is building for the downside. However, pullbacks are still part of the larger uptrend unless key support is violated, okay? Key support is quite low actually, but any major move down, like a 8 to 10% drop, right? I mean, it's probably a buying opportunity because the bull market is still going on, okay? Although if it does correct, right, it's probably going to be a matter of weeks and not days. Okay, so on a short term, so this is actually a weekly chart, right? So if I go to a daily chart, so you can see what's really going on a short term, yeah, you see the same thing, So if you look at the most recent activity, right, you got this small reversing candle on heavy volume. That's not a good sign. Then you drop to the 50-day average over here, and you are flirting with it right now. So based on just this, short-term rules indicate that there's a bit more downside at this point than upside, unless you recover from the 50 on good volume, good news. However, based on what I see on the other indicators, right, that seems a bit unlikely. So there's at the very least there should be one more move down, at the very least. Okay, so let's talk about tapering. Okay, back up. Okay, here. So here's the Fed tapering. Okay, so this is actually QE1 2009. This is the Fed net purchases of treasuries, U.S. agency bonds or like corporate bonds and mortgage-backed securities. So here's all the money that the Fed pumped into the market. Okay, there's one second round here, and now third round. As you can see, the third round is scheduled to end sometime between October and November, I think. Right? So this becomes, even though the end of tapering may not impact the economy straight away, but it does give a psychological reason for sell-off, because you'll notice when the QE1 finished middle of 2010, then QE2 finished middle of 2011. Okay, and if you look at the stock market at that time, right, these areas were characterized by sell-offs. So let's just look again. Let me see if I can find a good chart for that. Okay, see, middle of 2010, sell-off. Middle of 2011, sell-off. Right? So there will be traders, investors that will know this phenomenon, and it becomes a convenient place for sell-off when the tapering ends. Okay, so if the sell-off occurs, that will coincide very well with a major correction, like the fall which I talked about. But because econ data is supposed to recover, it's supposed to get better, right? That will eventually push for a fifth wave at least. Okay, so that's for Fed tapering. Let's quickly go to an update for the bull-bear ratio. So we noticed, last month, September 9th, it was 4, which was very, very high. So now, because of the recent sell-off, right, it's dropped to 3.45. But the point of it all is that it's still on the high side, right? That means people are still, well, retailers, I guess you can say, are still bullish, it just simply means that on the short term, there's potential for further correction. That's all it means. Okay. So here's just a reference of every time the bull-bear ratio was 3 or more, which is the red lines, and you notice that it just shows you that it could start a bear market, or it could have short-term corrections, right? It could be big or could be small. Okay. All right. For your reference, this is what it looks like when it's 1 or less. Okay, so that's it for the S&P. Let's quickly look at the SG markets because of time. So very quickly, it's like this. We've highlighted 2 zones here, support and resistance. And these zones, we've highlighted it for a few months now, actually. And we are still trapped within the resistance zone here. Okay. So at this point in time, because the situation in the US is tenuous, in the sense that econ data is resilient and the uptrend is still on, weakness is building up, but we don't know when it's going to break. So short-term caution is actually advised, and I would advise to look at which way the price breaks up from the resistance zone. If it breaks up this way, it's probably going to hit its 52-week high at 3,005 around there. If it drops this way, the next major support is actually down here. Okay, the major one, I mean, over here. So if the US goes through a prolonged correction, then likely this will also drop down to this level here. Okay, but if not, if the US is still resilient, or that the correction is just very minor, right? Then there's possibility of a consolidation breaking over here, as long as data remains good, economic data remains good. That is, yeah. And also, there is money. Money could potentially come in. I mean, numerous markets have already exceeded that 27 high, like those US, China, Malaysia, and of course, China looks like it's got signs of bottoming out as well. Okay. So for Singapore, I'd say have a trader's mindset as well and see how this consolidation plays out. Although I must say that this pattern over here looks a little bit weak. Wouldn't be surprised if we dropped down before we went up again. Okay, so that's it for Singapore. And okay, so just I guess you already know this since you're logged on. But if you do want to log on, to see our live webinars, then please go to uniphilip.com. Education programs and click on Philip Securities Research Webinar. Yeah, then you can get access to our live video and our archive stuff. And so we will take questions at this point. Thank you for listening in. Any questions?
Hello, sorry, there's a question on what is Kaplan motivation in its recent divestment of wanted interest in Marina Bay Financial Centre Tower 3 to cover its foreseeable bad annual performance by tweaking its book? That's the question. Sorry, but we do not actually cover Kaplan currently. But from what I actually look at the results accordingly for the first half of the year, I do not really see such claims on the bad performance. But what I feel is that for the divestment, I believe the company Kaplan is trying to actually unlock the values and to actually prepare itself to lower its gearing and prepare itself for overseas acquisition, as we believe that the growth currently in Singapore is quite limited at the moment. Thanks.
Hi. About the Australian economy, right? We have a question about what about the Australian economy. So let me just give a market outlook for Australian economy. So first of all, the Australian economy, right, is trading right now at 15 times PE. And that what 15 times PE is actually on the high side of their historical valuation. So right now it's actually getting a bit overpriced based on valuation. Now, what does that mean? Okay, basically, our analysis on Australia suggests that the market has priced in all the low-hanging fruits, meaning based on easy access to liquidity, stocks have gone up, essentially. And at 15 times PE, if you look at the Australian market, you should only select stocks that have real growth prospects on it, basically. So we think that stocks that will outperform this for this season right now are stocks that have their own growth stories to it. You shouldn't expect too much macro help for Australia at this point in time, especially when mining capex is actually going to start to decline slowly from here on out. Yeah. So between the mining capex declining from here on out and the stimulus from the Australian economy because they increased the infrastructure budget, between these two things, it will take some time for a new normalization of the economic data. So this period of time, you probably, at 15 times PE, you should only look at companies that have its own growth stories and not expect too much help for macro at this point in time. Okay, I'm getting a lot of questions on Elliott wave theory. I knew I was going to open a can of worms when I put down the count. So let me just try to give a bit more color on Elliott wave. All right. The questions that I get is, what's the duration of wave 4 and how much could it correct? And even before that, what is wave 4? Okay, so let's just go back a bit. Okay. Go back. Okay, here we go. Okay, the thing about Elliott wave is that the simplest pattern just takes just 5 minutes to learn. However, a true Elliott wave technician, right? There are many different types of variations and exceptions, but each variation and exception still abides by certain rules, and that's where the issue is. So I cannot tell you exactly how big the correction will be, but I can tell you some interesting phenomenons. Okay, for example, if this is a true 5-wave phenomenon, then there is a rule of alternation that says that if there is a 4, the 4 tends to be of a different nature from the 2. So if this is really the 2, like 1, and this is 2, that means a quick correction down here, and this correction, as you can see, hit this here, which is basically almost 1/3 of the move down. Okay, it basically says that the move 4 will not be like this. It could be a whole lot worse, or it could be even a very gentle one, or even a consolidation. So I cannot tell you how big the correction will be. I can only tell you what could potentially happen. So we'll have to wait for it to come out. But we do know that it is a fall, meaning a fall is a time of, it will not be an up move basically. That's all we can say. The fall can be a sideways move, can be a down move, but it won't be an up move. Like very rarely will it be an up move. Sometimes it can be a gentle up move, but it must be consolidating. So the point is that fall is a time of profit taking, for the next phase up. Yep. So I can't exactly tell you how much it will correct. However, some good rules of thumb would be looking at the 3, which is look at this big move 3, then look at this smaller move 3, and this smaller move again, right? And if you hit a multiple of this, for example, if it retraces 1/3 of this move here, that would be a potential target, perhaps, or it could be 1/3 of this as well. This is also a potential target. So there are a few potential targets, right? So that's why when it does happen, we need to look at other types of indicators to determine how far it could be. Okay, sorry that my guidance seemed to be a little bit cryptic and very broad based, but that is the nature of Elliott wave. Yeah.
Hello, this is Linsin, the macro analyst covering China. So someone queries on our stance on overweighting on China, and how do you see that the students' demonstration play out and its impact on your China and Hong Kong weighting? So actually, for this, right, we are expecting there may be a lower consumer and business sentiment moving forward, with Hong Kong side continue to be very a bit resistant on the Chinese tourists as well as consumers, so affecting their probably domestic demand. But for the stock market, we are still seeing opportunities on the back of China Hong Kong Stock Connect, in the sense that it's not just pertaining to Chinese investors but global investors. So we maintain overweight on the China Hong Kong rating. Yep.
Okay, it's Ken again. Okay, let me see. Just like to thank some people for nice comments. There's a Joshua that says, "Great stuff, Kenneth. Thank you very much." I appreciate that. Please keep them coming. Anyway, but another question is, oh wait, where's that? Okay. The question is, could you explain slide 35 and its relevance on leading indicators? Very good question. Since we have time, I shall go to slide 35. Slide 35. Oh, this one. I see. Okay. All right. Since we have a bit of time, okay, let's talk about this one. The thing about, okay, if you want to see its relevance, actually, I've talked about it in our February 11th webinar. And if you look at our past archive webinars, every time you see something that says TA, I've actually talked a bit about it during that time. Okay, but I will talk about it briefly now. Okay, essentially, when things are going in an idealized way in terms of the market, okay, now every market cycle can be a bit different depending on why it's having a bull run and what happened before it, etc., etc. But in a typical cycle, if the market behaves in a, how shall I say, normal way, where the economy recovers, or rather when the economy is contracting, the Fed jumps in to decrease interest rates to stimulate the economy, liquidity abounds, and then the stock market goes up, economy recovers, then inflation goes up, and both the stock market and inflation keep going up until central banks decide to tighten the economy. Now, when this happens, right, and if this is the normal cycle, then we have sector rotation that usually occurs. Okay, I mean this chart over here. Meaning the red line here is your actual stock market cycle. As you can see, the top is over here. And then the green line is your economic cycle over here. As you can see, your economic cycle actually is lagging the stock market cycle because, business owners, analysts, etc., they are preempting what happens in the economy when they make their business decisions. So you notice that the top of the stock market occurs even when economy is still recovering, for example. And by the time it's fully recovered, actually the stock market is probably dropped by then. So, okay, but this just shows you one thing, that in big ways and small ways, people usually get bullish on different sectors at different times. So in a big way, we see that cyclicals tend to come first, followed by tech, industrials, basic materials, and energy. Of course, they can be great overlap. I mean, even in this overlap you see here might not be as ideal as this. The overlap can be very big, but this gives you a framework. Okay, some things tend to lead first before others. Now, with that in mind, that's when we go back to this over here. So, and this happened for the last 2 years, right? We actually saw this phenomenon occur a few times, where even in terms of cycles, intermediate move ups or down, this sector rotation is in effect. For example, you see in the cyclicals here, it turned down in 2014. When I say turned down, I'm talking about relative leadership. Obviously, on the whole, there's an uptrend, right? But in terms of relative leadership, it turned down in 2014. And then later on, industrials actually turned down way later over here. See, June is when it really turned down. And then materials, well, it hasn't quite turned down yet, but based on this and this, I expect this to turn down eventually. See? So it gives you, so how it can help you is that, but at the same time, in a bull market, right, all of them are actually going up, right? But this can help you decide where to put your money, because certain sectors will probably go up faster at different parts of the cycle than others. So that's how one way of using this as a leading indicator. Okay. If you want, of course, using this, right, cannot be used in isolation. Let me just say that. Sometimes things can happen to distort the leadership patterns. So even this has to be used in context of other types of market analysis. So probably next year, right, I'll probably have an actual class that can teach people how to interpret all these things properly. But now I just present the data to you so you have access to it. So I hope that answers your question. Oh, good question by I have a good question by this William Tay, right? So great. You mentioned that oil sector will be an indication of the end of the bull cycle. Right now, oil sector is softening. So when's the next run up? Well, you are correct. When oil sector is not leading, right, it's a sign that inflation is under control. Inflation is not rampant. So it means that there are additional fundamental reasons for two things. One, businesses, right, are not margins will not be compressed so much because of energy costs, right? So they have a chance to improve earnings, or at least maintain earnings. Okay, and of course that's good for a bull cycle, right? And second, when inflation is under control, like it is now, the Fed doesn't need the Fed can basically feel more passive about when to raise their rates, right? And essentially, the end of the bull market will start after the Fed raises their rates. So as long as inflation is under control, that's good news for the stock market. So if the oil sector is softening, it means in a sense that the bull market has longer legs, you can say, because the Fed can now will not be in such a great hurry to raise rates. Um,
Hello, someone actually asked about the projected PB and PE of Sinarmas. The projected PE of Sinarmas is about 12.6 and the projected PV is about 0.74. Thanks. Another question is, why is OSIM continue to show weakness despite the bond saga is over? Well, from what I actually see, I do not see any strong strong reason or push factor that actually pushes the price down. But I believe that while the company still has not announced any plans for the huge amount of cash holding they are holding, people are taking a cautious stand on OSIM. Thanks.
Okay, so of course, some good questions coming up. Not talking about sector rotation. So there's some questions about, hey, in Singapore stocks, right? Where can we find classifications of this on poems or things like that? Okay, the thing is, one thing to note. There's a reason why I don't present like Singapore equivalent of the different sectors here, because the thing is that in the US, the different sectors are done in such a way that the companies under the sectors are done in such a way that is a good representative of the overall economy itself. Okay, because of the nature of all the blue chips under these particular sectors, we find that in Singapore, right, a lot of the classifications are not real classifications. Sometimes certain sectors only can have a few stocks, and we find that those particular stocks are so specific in the commodities or whatever they are trading in that it cannot be used blindly in terms of like a sector itself. So unfortunately, right, it's better to understand the principle of what's going on here, okay, and then using it to look at the type of Singapore stocks you're looking at. So for example, over here, industrials are supposed to do when the trading end of industrials supposed to do well, and here means that inflation inflation basically is weakening, but it should on the longer term be going up. So the question you should ask yourself is, which type of companies will do well when inflation and commodity prices start to go up? So for example, if you do mention something like maybe like a oil palm company, crude palm oil company, right? Yeah, those would be an example of materials. However, if it's just one product, crude palm, right? That's very specific to that particular commodity, and that might have its own reasons that affect the price of crude palm oil, not just global inflation. That's what I mean by you have to be very careful how you use this data into Singapore stocks.
Hello, there's a question that asks, where can we find stocks under each classification within poems? Under poems, if you go to LP2, there's actually a section called sector where you can see the classification. It may not be actually classified as energy, staples, and what cannot have presented, but let's say if you click under agriculture, you will find the CPO stocks under it and so on. Thanks.
Okay, there's a question that says, since the European countries are very weak, how far down can the DAX 30, which represents Germany, and UK 100 can go down? Okay, technically speaking, like I said, Germany is mostly down because of the sanctions that they had put on Russia. Now, Germany, the export to Russia is not huge. It's compared to the total export, it's like a very small number. So it won't affect Germany a lot. Right now, what you see on the German market or the deteriorating growth is, I think, would continue at the same pace for a few months from now. Right now, DAX 30 is mostly affected by the downward trend or the lack of consumer and business confidence. But I don't think until and unless there's war, I don't believe that this will Germany will be affected a lot in future. Having said that, it will still be on a lower side. UK, on the other hand, although we don't cover UK per se individually, but UK prospect wise is better than Germany right now.
Okay guys, we got one last question before I call it a day. We already went over time by 25 minutes. Okay, but before the last question is this, we've had a lot of good comments. So like Annie says, today's session is very good. Thank you very much. So if you like what you have heard so far, do us a favor and you can tell all your friends about the webinar. So the more people that log on to the webinar, right, it's good for us and we can continue doing more quality material. So thanks for tuning in. And the last question is this. The question is, any change in view on Valuetronics? Good question. Okay, so since I'm on the line, this is the last question. Now, Valuetronics is a very interesting counter at this point in time. Okay, why do I say that? Now, from a high of 59 cents, it has dropped to, now the price is about 40 cents. So let me tell you exactly the risks and the reward of Valuetronics at this point in time. Right now, Valuetronics is actually trading cheap. PE is 6.5 times. Okay, PE x cash is actually back to 4 or less, which means it's cheap. Okay, so the reason why price has been dropping is for two reasons. Okay, first reason, there's been weakness in small mid caps globally. Okay, that's what's been going on because I think people are feeling jittery. But another reason is also that the last quarter had the last quarter results and outlook raised a lot of uncertainty in the minds of a lot of people. See, because Valuetronics basically has two segments. It's got the CE segment and the ICE segment. The CE segment predominantly sells LED retrofit light bulbs. And the thing is, right, for this sector, their performance in this sector has had a sudden drop in performance due to competitors. So this is actually, in a sense, I would say systemic and structural. That means it's actually a big deal. It's a big deal that their margins have dropped and their revenue has dropped. And people are pricing in the eventual death of this sector. Now, because of that, the price dropped from 59 all the way to 40. But there are two things, right, which we will only know when the quarterly announcement comes out. And the things that might turn this around, okay, is this. I don't know if the market is really pricing in what's been going on with the ICE sector. Because the ICE segment has grown more than 20% year on year. And the ICE segment, right, in terms of gross profit, is actually more than the gross profit of CE. So if ICE grows, right, it might actually really significantly offset what's been going on in the CE in the first place. And I already mentioned in my report that Valuetronics is transitioning out. In other words, the Valuetronics management have already recognized that the, how shall I say, the product cycle for the CE, it has an end, right? Maybe this had occurred faster than normal, but they've already, that's why they've been focusing on growing their ICE side. And that's why ICE revenues have been growing for 7 quarters in a row. And not just that, the next quarter is also probably going to grow as well, because in the first quarter of this year, they already had mentioned that they've added a new client for ICE. Okay, and the client's revenues have not been factored into the financial statements yet, which means the probability of next quarter being higher than this quarter is also there. And since that ICE already has gross profits more than CE, right, even if CE grows, I mean, so CE might drop, okay, or even it might even temporarily stabilize because their major client basically had to drop their prices and drop their margins in order to compete with all the competitors. So on a short term, right, maybe price can even, I mean, revenues can stabilize a little bit. But the point of it all is that they're in transition. So the key risk is, can ICE grow fast enough to overtake or at least to normalize CE? That's the key factor. And at a PE x cash of below 4, right, you know, it's very interesting to look at this. So basically, if the next quarter comes out and we find that the ICE segment is still growing, okay, which is likely to grow, and that the decay from CE is not as severe, then it's actually cheap at 40 cents. Okay? Oh, okay. And last question by Simon. When are you going to conduct TA course for TR? Yeah, we've been trying to get it done for some time, but because of time constraints, etc., maybe it'll be next year, early next year maybe. We'll keep you posted when it occurs. Okay, so thank you very much. We've already gone over time by 25 minutes, so thanks for tuning in, and we'll see you next week. Yeah. Okay. Bye.